Welcome to TMS Insights. We're on the footsteps of Christmas 2025. It's been another big year. Ben, I'm getting the sense that the market just seems to slow down as we're a week or so out from Christmas. It can tend to do that. It can tend to sometimes go really quite ballistic, but it feels like it's been a full-on year and everybody's quite keen to see things shut down for a little while.
Yeah, well, I certainly saw the roads on the way into work were massively quieter this morning. It feels like a lot of people are already taken off, and volumes in the market, it feels like it's just the passive sort of money starting to trade the market, which is what you get during these periods, and the active guys just sort of hang up their hats for a few weeks and have a well-deserved break. So we're going into that zone. Company news really dries up now as well.
We've been through that AGM piece. There's not a lot. Of course, there's always something that will come up.
You probably don't want news at the moment.
Well, it's not the ideal time, and so, no, it is that case. So just giving people a bit of a flavour of the year to date, and we'll also talk about what comes up and maybe looking into 26 a bit. So, look, it's been another good year. We don't know how it's going to end entirely. There's a little bit to go, but we've got an ASX which is up circa 5% for the year. If you throw in dividends, it's 9% odd. So they're certainly in good territory. The last 2 years were double-digit years. So, and again, not as good as international markets, the US market, having had a number of good years in a row. But this is certainly good times for everybody. Don't be afraid.
It's been like the index has done well. I would say it's been one of those years where there's been certain parts of the market have actually had a really average year, and there's been other parts have had a stomping year this year. And that sort of index components, I reckon when we look at Deck 31, we'll see there's some quite big negatives in some parts and there's some big positives in others. And I suppose that happens every year, but to me it feels a bit more elevated this year.
And I think we speak in years a lot. I like to think almost in quarters as well. And rarely do you see 4 quarters all the same. Particularly if you go back to what you were saying about some of the big performers and underperformers. We'll talk about an inflection point of around October where growth went on the nose and changes the year-end numbers a lot. But if we're talking about this 3 months ago, we would have had a different commentary altogether.
Absolutely. And the catalyst for that, of course, has been what's happened in interest rate markets. It's been a very big change in the outlook for rates, which has been rapidly priced in. The 3-year bond yield in Australia is nearly at a 15-year high now. So interest rates have dragged down the interest rate sensitive components of the index in this last quarter. But that feels like it's starting to, the bond market's starting to get comfortable with where it's pricing at.
The adjustments happen. But we shouldn't move past this point without talking about the US cut last week. The third in a row. And people would rightly ask, how come Australia isn't in that sort of same zone of cutting? And even New Zealand last month cut again, So what's different here? I mean, and we're talking about broader economic settings, and we have to address government spending here.
Well, I mean, Jim Chalmers doesn't want to talk about it, but it is a big component. The RBA is, I think, without being political, is trying to say you've got to turn off the tap. We know that, things like the NDIS and some of these big schemes, there's huge flows. But I know I was speaking to actually a fund manager on the weekend, and he was saying, a lot of this, he reckons, comes back to property. No one talks about property, but if you want to be able to rent a 1-bedroom or 2-bedroom apartment in Sydney, you need to, and you're a labourer, you need to get paid $50 or $60 an hour, or you physically can't live in Sydney. And so we all talk about a lot of those factors. No one talks about property prices.
Everything influences it in the long run. And
because it is bizarre. We are on a completely different outlook on our rate trajectory to everywhere else.
And it's changed only in the last couple of months. And it's a big change. And that's why growth stocks really paid the price, let's face it, and individual companies that missed earnings and all of that. So, but it will mean there's different sort of return profiles amongst different kinds of portfolios. Now, if we look at this time of year, just for everybody's benefit, we said it goes a bit quiet. Obviously, for everybody's benefit, the TMS office is open on non-public holidays as markets do trade, but it's awfully quiet, and the staff here are literally very skeleton staff, so we do want everybody to have some time off over this period.
Yeah.
But Ben, it does go quiet. What do you see over Christmas, New Year? Like, obviously, markets are dictated often by the bigger markets in the Northern Hemisphere, which do trade more than we do.
They do, because they don't take as long not their summer break, and obviously. And look, Jez, this tends to be a bit of a weird time of the year in that you can actually get, markets go up like 5 or 6% in a couple of weeks, or do the opposite, because the breadth of the market comes out of it. And so smaller swings can actually be exacerbated. We haven't...
And they tend to be on the upside.
They tend to be...
The Santa rally is a concept, isn't it?
Yep, I think.
And the January effect in the US. So,
yes.
And I find January can be quite a busy month in markets.
Totally.
But not driven by local events. It's really offshore events.
Yep, that's right. So, and we still have had a few results filtering through from the end of the US quarterly reporting season, which we'd again say, has turned out to be fantastic.
Really good,
a couple of softer ones at the end of it, I would say. Broadcom late last week. Underwhelmed, and so did Oracle, which have been two of the poster childs for the AI trade. So that's just showing some signs of taking a breather. It's not rolling over, I don't think. It's just probably impossible to continue to.
Yeah. So when we look at this, we tend to take the point of view of saying what we're trying to understand at the moment is this AI thing.
Yes.
Is it for hot air? And that's going to be the big decision into 2026, isn't it?
It is, and I think it's the big decision, and it's also, there's this growing sort of awareness of what are the knock-on effects onto other businesses, maybe other software businesses or other businesses. And we've seen in the tail end of this year, there's been some pretty decent sell-offs in some of the industries that are seen as susceptible to disruption by AI. And I think that's going to be something which is going to grow in 2026, is going to be trying to understand what the timing, or if it's real or if it's not next year. But, I'd still say don't believe in this thing of the bubble or the hype. The theme is real, and it's only actually gaining momentum. It's what valuations are they reflecting the right outlook.
And it's great when we look at a couple of really good slides back to, say, the tech boom and bust now 25 years ago. Valuations of the Mag 7, as it wasn't called then, are still way below now what they were in those times.
Absolutely. So, and the businesses are much higher quality today than they were back in those times as well. There was no recurring revenue in many of those businesses.
Exactly. Cash on the balance sheet, strong. So, it's a different paradigm altogether. All right, well, big predictions for 26. What do you think?
That's a good question. I think
no more rate cuts in Australia.
I don't think there'll be a rate hike next year.
Okay.
And the bond market's now pricing in a rate hike. I think jawboning will be alive and well when it started. But I don't see us diverging so dramatically against the rest of the world. And for that reason, I think if I looked at some of the laggards in our market, I'd say potentially the year of the bounce back in growth. And I call out healthcare as well as being an area of the market which for 2 or 3 years now has been has underperformed. Firstly because of the COVID issues, and then because of Trump. At some point that is going to go. Or RFK. Or Trump's nominees, absolutely. How about you?
No, I think I think that a stable outlook on rates. We'll get a negative quarter next year, just expect it. So if you keep your portfolio balanced and you'll be able to seize on opportunities. We had 2 this year, April, and then again in November. So if you were cashed up, you could take advantage of that. So I think you go into the next year expecting a reasonable year, but it's going to be hard for it to keep the momentum up throughout the whole year. I predict 2 quarters of probably flat to negative, and a bit of opportunity in one of those. So you just be aware of that, and that's how you build portfolios over time. But I think we've now got, like you said, some growth stocks have materially good value. So
Yeah.
I think you go into that wanting to be invested in the better names.
And that looking back at 2025, that was actually another interesting component. Was we only had 2 corrections in the entire year.
That's right.
Which was Liberation Day
It's rare.
and November, and that is unusual.
Yeah.
That was an unusually calm year, I'd
Yeah.
say, given all the stuff that's going on in the world.
That's it. They're both opportunities, and we'll get more, so it's all good. But that's all for today's video. We're going to now farewell you for 2025. We wish every member of our TMS family a wonderful Christmas and a very safe and happy time with family and friends. And we look forward to being back in front of you, bringing you all the news in 2026.